Hi guys, welcome to our series of 365 days, 365 concepts. Today we would be discussing the concept of asset turnover ratio, right? So what is the formula for asset turnover ratio? What is the aim of calculating the asset turnover ratio? What does it mean? Let's get started. The formula for the ratio is simply revenue divided by total assets. So why do we calculate this ratio? What is the aim of calculating this ratio? Let's assume that we have a business which is doing a revenue of $2 million and has $1 million invested in its assets. By virtue of this, we can see that the asset turnover ratio for this business is 2. What does this imply? This implies that for every $1 invested in the assets of the company is able to generate twice the revenue. It is able to generate $2 revenue for every $1 invested in the assets. Now let's assume another business which is in the same line is able to do an asset turnover ratio of $5. What does this mean? For every $1 that is invested in the total assets of the firm is able to do only zero point 0.5 revenue for that $1 invested. So if I consider this to be business A and this to be B, we can see that business A is performing relatively better. It is able to efficiently utilize its asset as compared to B. For B, we can pass on a statement that too much capital is being tied up in B's total assets and it is not able to efficiently utilize the total assets that is there with this. Now, whether we straight away say that there is a number that could be used as a benchmark that above this the asset turnover ratio is good, below that number the asset turnover ratio is bad, how do we judge whether a good asset turnover ratio looks like? So let's assume that there is a supermarket which sells fast moving consumer goods and it is doing an asset turnover of 5 to 6 times. Let's assume there is an airline which is able to do an asset turnover of 0.75, right? So, can we say that supermarket is a better business as compared to airline just by virtue of this? The answer would be no. Every industry operates differently. The amount that might be invested in a supermarket in its total asset is too little as compared to an airline company which has to purchase a fleet of aircraft, which is a very capital intensive thing to do. The amount that is invested in case of supermarket in the total assets is too little, as I just said. So by virtue of this, the denominator becomes small and hence the total ratio shoots up. So the best way to analyze things is to compare a particular business with the other peers and competitors in the industry itself. If I have to cite a real life example, in the last fiscal year, Infosys, or as we call it Infi, did an asset turnover ratio of 1.2. On the other hand, Tata Steel did an asset turnover of zero point 0.2. Now, Infi here is a very capital light business. The employees, the human resources are the real capital for Infi. They are the real assets. The heavy assets in which we generally invest in plant and machinery, very little amount is invested by Infi in assets like that. Again, by virtue of that, this denominator comes down and the entire ratio shoots up. On the other hand, Tata Steel, which did an asset turnover of zero point 0.6, basically will have a lot of amount invested in the total assets. So the best way to judge both these companies is to compare Infi with other competitors, let's say TCS, HCL Tech, similarly Tata Steel to be compared with JSW and whatnot. Then only we can say whether which business is doing good or not. We can't compare Infi with Tata Steel. We can't compare a supermarket business with an airline company. So the best way to judge things is to compare things within an industry with the pairs and then come to a conclusion. We should not judge ratios in isolation, right? So that was a bit in terms of asset turnover ratio. Hope you enjoyed this concept. We will see you another day with another concept. Thank you.